Thank you, everybody. We do appreciate everybody being here today to talk about how non-QM loans can close more deals and help more of your buyers. So as Allie mentioned, we do want that interaction. So please do use the chat box. My understanding is we'll go through the presentation at the end. We'll go through all of that Q&A. So please do speak up. If you're thinking it, somebody else may be as well. We're going to start with talking about some products. We're going to talk about exception-based lending. That's one of the beautiful things about non-QM. And then we'll talk about some resources that they have here for you. I do want to talk about the opportunity in the non-QM space, right? I like to refer to non-QM as alternative financing solutions. You use the word non-QM, folks may think back to perhaps that old subprime day, right? And that's not the case. When we look at data on the non-QM space, fast forwarding here to 2025, these are really well qualified borrowers, good FICOs, just simply looking for an alternative way for a lender to look perhaps most often at their income. So, I think just understanding that terminology is very important to use. These are alternative options, and it's growing. If you look at data in the non-QM space over the most recent 3 to 5 years, every single year this grows. Some recent stats that I have for you that aren't here on this slide is the fact that in 2025, non-QM is expected to be an $80 billion to $100 billion opportunity. If you go back to 2023, it was 37 billion. 2024 closed out at roughly 70 billion. So every single year it's growing. And that's because of organizations and loan officers that you work with embracing, understanding, and educating themselves on this product base and knowing that we cannot just be vanilla anymore, right? We can't be just Fannie Freddie conforming loans. We've got to be able to serve every single well-qualified borrower that indeed we can. So we've got several different features we're going to talk about, and a lot of it is to do with the self-employed borrower. We have more self-employed borrowers in our country than ever recorded before. And I think often from a mortgage standpoint, that net reported on income on that tax return can sometimes be problematic. So we're going to talk a lot today about the alternative options for self-employed borrowers. Another opportunity is the investment population. We have more investors in real estate than ever before. As a matter of fact, it grows every single year by 7.3%. If you look at IRS data going all the way back to 2006 through 2023, 2024 data is not in, but I'm sure that trend will continue. You have an increase of 7.3% every year of people reporting income off of rental properties. 28% of the purchase money last year per CoreLogic was indeed the investor. So again, investors need solutions outside of that traditional, let me see your tax return and what you're reporting on that rental income, right? We all like our IRS tax code and taking all those legal deductions and netting our income down, but sometimes that's problematic when it comes to a mortgage. Another segment of the market we're going to talk about is the heavy asset borrower. We have got a lot of millionaires in our country, and assets can be used as income as perhaps a path of least resistance for a borrower to qualify. So we're going to talk about that segment as well. So big opportunity. 63% of the non-QM market is indeed purchase money. So getting familiar with these products and partnering with a lender who is not, as I like to say, just vanilla, right? If it doesn't fit into that box that Fannie, Freddie, or Prime Jumbo carve out, right? Are you going to be working with an originator who's going to look beyond that and try to assist you in making these buyers' home ownership dreams come true. So that's what today is all about. Here's some projections that we talked about. So just a little graph here for you about that growth. You can see year over year continues to grow. Let's talk about these solutions. What are these products and these solutions that can assist these borrowers? Expanded Prime is the most used product, especially for that self-employed borrower, because it offers the lowest price point of the product base, and B, the most alternative ways to qualify that borrower outside of looking at the tax return, indeed when they're self-employed. You're looking at a 660 FICO borrower. So again, this is not the old subprime market. If you look at 2023 data, the average FICO of a non-QM borrower is 700. Only 32% of the loans that closed last year had a FICO under 700. So again, these are well-qualified borrowers. This is not the old subprime market, right? These are responsible loans, disciplined with good FICOs, that are simply assisting borrowers who may fall outside of that Fannie Freddie prime jumbo box. They're being underserved. So we're here to serve that borrower. Loan amounts go as high as 3.5 million. So if any of you agents are in the space where you are listing properties above what Fannie Freddie consider their loan limits, right? We know that conforming has limits on how much money they will lend. Same thing with high balance. So if I go outside of that, I've got to get a prime jumbo loan. Well, prime jumbo loans are all full doc. There's no other way for a loan officer to qualify that borrower other looking at their tax return or W-2s and pay stubs for that wage earning borrower. So debt ratios are usually considered to be lower on a prime jumbo, right? 43, 45% of that borrower's income can be debt. Sometimes you can go over that with the DU product that may be out there, but there's a lot of fallout in that jumbo arena that these products can indeed serve. If you don't have those listings, it's an opportunity perhaps for you to go after that. Now, loan to values are up to 90% on the purchase and rate and term market. So if you're dealing in the purchase arena, as you agents are, realtors are, they need at least a 10% down payment. Average loan to value of that $70 billion that closed last year was 70. So again, these are generally borrowers with good down payments, good FICOs. They generally either have employment, income, or debt structure issues. This product goes as high as a 50% debt ratio. With your agency or your prime jumbo, there's limitations on what that debt will take, generally capping around 45. Can you get things approved 46, 47, 48? But it becomes a little bit more tenuous in that conforming arena, where here it's simply a 50% ratio of their gross income going out every month in debt. The other difference with non-QM is there's no what we consider a housing ratio. So in the agency space, prime jumbo space, a lender has to analyze what percentage of that borrower's income is being spent on housing. Well, what if I've got a borrower who yeah, despite the American way, right, doesn't like all those credit cards and, doesn't have a lot of debt, and they want their debt structure to be totally in their home. It's their free will, right? So it gives a little bit more flexibility to serve borrowers based on their individual needs. You don't have to have a housing history. You could be a first-time home buyer and use these products, as long as that first-time home buyer is purchasing a primary or a second home. So opportunity, I think, abroad as far as home ownership. Now, these products do allow borrowers to refinance. So if you get any clients looking for refinances, right? We know cash out's a big thing right now, consolidating debt. Credit card debt's gone from 947 billion in 2020 to around 1.2 trillion with a T. So we're seeing a lot of debt consolidations. So if you know folks, refer them over there to your originators for those refis as well. Delayed financing can be used. What's that? It means 30% of buyers are still paying cash. So, right, you all know that it's a competitive market. Some sellers are even demanding in certain markets that it's a cash buyer. Maybe they've got to move, right? They got a deadline to get into their new home. They want cash only. So a borrower could pay cash, come right back, utilize these products and get their cash back in hand. So if you've got cash buyers who are in a situation of paying cash either because it's a competitive market, or perhaps a loan officer looked at their tax return and told them they couldn't qualify. I got a deadline on my contract. Now I got to pay cash, don't I? Right? And now I can get that back later on through a refi here, using these features. Property types, standard property types, right? Non-warrantable condos is what I really want to focus on here. What does that mean? Fannie and Freddie, your conforming loans, your government loans, your prime jumbo loans, all the other standard operating products that have been in the market forever, require that condo to meet certain guidelines. And if it falls out of that, that borrower can't get that loan because of the property. So non-warrantable condos, if you are having any condo listings and you're running into situations where that condo isn't meeting those conforming guidelines, you got an opportunity for that particular property type over here. Other than that, non-QM is really not here to solve problematic properties, right? We're really solving borrower issues, but we do like that non-warrantable. Let's talk about the solutions. This is the big use. This is what we've been talking about since the opening of the session, is the alternative income solutions. Now, your borrowers still have to have a 2-year work history. That's standard in the mortgage industry, right? I got to show either I'm schooled in the field that I'm in and I've got work history, or I've had jobs in the same line of work or field for 2 years if I'm a wage earner. If I'm self-employed, all of your conforming and prime jumbo product, as well as your government products, require a borrower to be self-employed for 2 years or more in order for that income to be considered stable. Same here. We do prefer a 2-year self-employed borrower, but we can close a borrower who may have only been, who has been self-employed less than 2 years, but a minimum of one. If you can tie in that they have the experience in their previous role or their previous employment to handle being self-employed for less than those 2 years. We'll never do anything less than 1 year. Let me give you a couple of examples of loans that closed. We had a borrower who was a general manager for a fast food chain, right? The franchise owner, it was a franchise. Franchise owner had 6 locations. This gentleman managed those for 6 years. He did inventory, payroll, hiring, firing, and ran those fast food chains, 6 of them. And 16 months ago, achieved his dream and bought his own. That's not going to fly with a Fannie, Freddie, prime jumbo, or government loan. Not going to work out very well. Got to have 2 years where we were able to close that loan because we tied in the previous experience. Happens sometimes with attorneys, right? I pass my bar. I do what? I go to work for a law firm as a wage earner. And what am I trying to do? I'm trying to make partner. Once I make partner, I'm a K1. I'm a self-employed borrower. We closed a loan like that. They had been an attorney for the firm for several years and 18 months ago made partner. Technically, they're not 2 years self-employed, are they? That's not going to run in the conforming market. And that was able to be placed over here in the non-QM bucket. Want to talk about income and how we document income. That is the benefit of non-QM from a full documentation standpoint, meaning the traditional way a borrower qualifies, right? If I'm a wage earner, I give you last year's W-2 and I give you a recent pay stub. If I'm self-employed, I give you my tax return. That's how all those vanilla products work. Well, that's fine, right? That works bulk of the time. Not every borrower needs a non-QM loan. We're not saying that. We're saying we need to explore every avenue. So the way this one-year bulldog works is perhaps it's a situation with a commission borrower. This happens a lot with commission salespeople, right? So let's say I worked for Bob's Buick. I sold cars over there for a couple years, and then 13 months ago, Cat Chevrolet rang me up and asked me to come sell cars there. Well, okay, I went over there, but now I've only got 1 year commission. Agency generally calls for a 2-year average of commission income at the same employer. So here, if I can show that my borrower's been in the same line of work or related field for 2 years, and I've only got 1 year receipt of commission income, I can use just that 1 year receipt of that commission income. Maybe a self-employed borrower where your loan officer runs that file through the automated underwriting system. That's what happens on conforming loans, right? Government loans too. They go through AUS, automated underwriting system. With Fannie Mae, it's called DU. With Freddie Mac, it's called LLPA. That spits out findings and it tells that loan officer you can do the loan or you can't do the loan. And here's how I need you to document the income. Sometimes for a self-employed borrower, depending on the risk level and the algorithm of that software program, it will say, yeah, 1 year receipt is fine, long as you're 2 years self-employed. But sometimes it'll call for a 2 year look back, where I've got to average that self-employed borrower's income over a 2 year time frame. Well, what if that hurts the borrower? What if their most recent year of income is higher and that weighted 2 year average is problematic, right? You can come over here and just do 1 year. There is no AUS. These loans are manually underwriting. That is a benefit. That means a live human being is indeed looking at this file and can use some common sense for that borrower and not depend totally on an algorithm of a software program determining the eligibility of that borrower. I want to talk about assets as income. Now, agency or conforming loans, they do use assets as income. They call it asset depletion is what they call it. We call it using assets as income. It's very different than how agency looks at a borrower's assets. So I could have a borrower who has heavy assets, but has a debt ratio problem, right? I could take those assets in a bank statement, right? Look at the bank statement, do some math, divide the balances over 84 months. That's a simple version of that. And add it to the other income and try to solve their debt ratio that way. The borrower doesn't have to pledge the asset. They don't have to liquidate the asset. They just give me a statement and I do some math. I could also use that feature for a borrower who has assets who may have an employment challenge. What do I do if a borrower is self-employed for 9 months? Never going to work, is it? Anywhere, other than hard money, maybe, right? And if they have assets, I could do no employment, no income from a primary job, leave that out of the equation, just do the math on the asset and qualify them at a 50% debt structure just using the asset. I could also use an assets for a borrower who doesn't want to adhere to any debt structure. No employment, no income, no DTI. We closed a $2 million second home that way. Borrower was purchasing a $2 million home, second home. High-level CEO at a large corporation was terminated from his job in the middle of that purchase. He had $5 million in a retirement account. Could he have liquidated that and paid cash? Yeah. Did he want to? No. He gave us a 6-month statement on that asset, and we used that for a no ratio, no employment, no income loan. That's a very stable borrower. He's got $5 million in reserve. I think he's going to pay that bill on time, right? That's where common sense comes in. Now, the self-employed borrower, in lieu of a tax return, now many self-employed borrowers will qualify just fine off of the tax return and go conforming. But you want to look and work with an originator who's going to look at things from every angle, right? We have so many different ways to look at a self-employed borrower's income other than using that net reported income on that tax return. And the most popular feature is the bank statement feature, where they can give your loan originator a 12 or 24-month bank statement, will calculate their income based off of the deposits within that account in lieu of a tax return. Since there is no tax return in the file, we don't have to validate that a return has been filed with the IRS. All Full Doc loans, when I submit a tax return to a lender, they've got to send a form on over called 4506 to the IRS and verify that what is in front of them on that return is the same thing that was filed with the IRS. That's time consuming sometimes, and especially in April can get a little cumbersome. So here we're not using the return, so we don't have to validate what, if anything, has been filed. We're calculating income off of a bank statement. Now, 90% of what we do is 12 months. Most folks qualify just fine on 12 months. Really kind of use that 24 if I'm dealing with a seasonal type business, right? I happen to be here in the great state of Michigan. Our ground's starting to unthaw. If I'm a landscaper, I'm probably not showing a lot of income over the last 3 months, 4 months, depending on how our winter goes. So a seasonal business, we highly recommend doing a 24 look back. It is personal or business bank statements. I can use either or. I could use multiple accounts, multiple personal accounts, or multiple business. So your loan originators are experts in qualifying that income. And just like any other borrower, they can tell you the purchasing power right up front. Based off of that income. They're just looking at it differently. They're just looking at it and asking borrower for bank statements instead of, hey, give me your tax return, right? Now, a lot of loan officers use that feature to test, if you will, the purchasing power of a borrower. A lot of originators will say, well, give me your tax return. We'll see what that qualifies you for, and give me 12 months bank statements, and we'll see what that qualifies you for. We had a loan officer just the other day on a call say, yeah, I do that all the time. Based on a tax return, I qualified a borrower at a $350,000 purchase price, but looking at his deposits, I was able to bump that to 400. So if self-employed borrowers are struggling, being put in a box, if you will, on what their purchasing power is, let's look at it a different way and see if we can get them to their home ownership goals that way. There is another option for a self-employed borrower in lieu of the tax return, and that would be a 1099 borrower. Many of you, unless you're the broker owner of your real estate firm, probably get paid this way, right? You sell a property, you get a commission check, and get a 1099. So a lot of 1099 borrowers out there. And in lieu of a tax return, you could gather last year's 1099. So I would just ask you for your 1099 document, not your return, just your 1099. I would then get year-to-date bank statements. It's only March, so I would gather two. We'll look at the income based off of the deposits in that 2-month bank account, year-to-date. Add it to 100% of your income as reported on the 1099, not the return, and divide that over the number of months. That would be a 14-month math doing that today, right? I got 12 months on a 1099 and I got a 2-month bank statement. So just another way to serve that self-employed borrower who happens to get paid on a 1099. Now, I certainly could do a bank statement loan for a 1099 borrower. I could go 12 or 24 months personal or business bank statements and look at their income that way, right? Just another way to look at it. Which way is going to be best? I don't know. Maybe your originator is going to ask you for both. Let me look at your 1099 and your year-to-date bank statements, right? Give me 12 months bank statements. Let's see which one gives you more purchasing power. There's yet a third way to handle a self-employed borrower in lieu of the tax return, and that would be a P&L, using the net reported income off of a P&L in lieu of a tax return. Now, that P&L does have to be prepared, signed, dated, attested to by either a CPA, a EA designation, or if you're in California, a CTEC. So it can't be your PTIN, right? So it does not have to be audited. I know that's always a question because that's very costly for a self-employed borrower to have an audited P&L. It is not audited, just needs to be prepared, and we'll use the net reported income off of the P&L. So various different ways to look at the self-employed borrower in lieu of utilizing that tax return. Every self-employed borrower will be different, and your loan originator will assist that borrower in looking at the multitude of options and seeing what is going to be the best execution for that particular borrower's situation. That's the beauty of non-QM. It is not like an agency loan. One box fits or it doesn't, right? Here you have various different ways to look at the purchasing power of that particular borrower. And of course, all this can be used for refis, right? So don't forget about that. We do look at NSF activity. I think the beautiful thing about our guidelines in reference to NSF activity is that we don't tell in underwriters how many NSFs a borrower can have. I mean, we like to use common sense. These are common sense storybook loans, we like to say, right? There could be a situation where I had heavy NSF activity and there was a legitimate reason for that, right? There's a difference between a borrower who had a one-time event that occurred in the life of their business that's not likely to occur again, and a borrower with heavy NSF activity because they have a problem. Their business is in jeopardy. They've got a cash flow problem, or they've got a management issue. They don't know how to manage their funds. There's a big difference between those two borrowers. Let me give you an example. Two borrowers, relatively same amount of NSF activity. One borrower had a letter of explanation and said, well, yeah, I had a lot of NSFs over that 2 months because my bookkeeper was in a car accident, hospitalized, and couldn't return to work. And it created a lot of chaos for me in trying to run my business and get to the bank. There was no debt ratio problem. There was no cash flow problem. This was a unfortunate one-time event, and that loan was approved. This is where non-QM comes in. Doesn't make sense. Versus another borrower who had the same amount of NSFs, I think it was within two or three, if memory serves me right, but their letter said this: yeah, I overdraw my account all the time because my bank puts a 3-day hold on my credit card deposits. Well, I don't know about all you, but I think there's a lot of regulation around banking, and anytime I've made a deposit, my bank tells me it's going to be held and even gives me the opportunity not to make that deposit if I don't want that hold in place. So that's a management or cash flow problem if I can't sustain a 2 to 3 day hold on my credit card deposits and I'm constantly overdrawing my account. And that one was not approved. So that's why guidelines should say NSF activity could preclude the borrower from being eligible. We don't want to pigeonhole underwriters into saying, well, they can only have two over a year, or five, or three, or none in the last 3 months, two over the life of 12. Guidelines are all over the place when it comes to NSF activity in the non-QM world. We keep it open for our underwriters to use common sense based on the particular situation of that borrower. So business bank statements, that borrower, in order to do a business bank statement loan in lieu of a tax return, has to own 25% of the business. So I don't want to get too granular for your agents. That's why you hire loan officers, right, to know all these details. But let me give you a general overview of how that income works. We look at the eligible deposits in that account. We times it by whatever percentage the borrower owns, because if I don't own all the business, right, then I don't own all those deposits in that business bank account. That's not all my income, is it? If I don't own all the business. So that's the first math your loan officer will do. The second math is to apply a 50% expense factor. What does that mean? It means that I'm going to cut those deposits in half and then divide over 12 or 24 months to get the usable income. Why is that? It's a business account. Not every deposit in a business account is pure profit or income, right? I'm a business owner. I have costs associated with operating my business. Now, yeah, clearly not every business operates at 50%, but we've got to have a standard. 50% is what it is. Now, there are some businesses who run higher and some businesses who could run lower, right? We don't go higher than 50. There are lenders out there in the bank statement lending world who apply a higher expense factor for, let's say, a restaurant or manufacturing, just understanding the inflation in those areas, right? We all go to the grocery store. We know a restaurant's cost of operating their business has gone up by about 36%. But we don't do that. We're still holding at 50, regardless of the type of business. Now, if that income works, your loan officer is going to proceed and get that file closed for you. But if that 50% expense factor is problematic for that borrower, and we know that we're dealing with a business that could run lighter, right? Maybe I'm CATS training. I work from home. I've got, a laptop and maybe some visit cards, very little expense. So your loan officer could ask your borrower and place the burden of proof on your borrower as to what their actual expense factor for their business is, and ask them to get a letter by a licensed tax professional. Now, a PTN could write that letter. I just have to have a license for that letter, right? And say, well, CATS training has a 10% expense factor. Well, that makes sense. CATS has no cost of goods, no employees, no office rent. That makes perfect sense to me, doesn't it? Common sense. And now I can only cut those deposits by 10%, increasing that borrower's income by 40. There's yet a third way to make that business bank statement work. Let's say the 50% expense factor doesn't work, and the borrower may come back and say, hey, my tax preparer, they're a little bit uncomfortable writing letters. We all know that happens, right? Okay, well, could they prepare a P&L for you? If they could, now we can get that P&L. Most CPAs will prepare a PPL or a PTIN, right? A licensed tax professional can print that P&L off. And now, if the deposits in the bank account are within a 20% margin of what that gross revenue on that P&L is, you just go to the net income on the P&L. So I know that's a lot of detail, and maybe not necessarily everything you might want to know, but I want you to understand the check down that your loan originators go to in an effort to help every buyer that they can that qualifies under these guides. Personal bank statement loans, they work a little bit differently. Personal accounts, the whole concept of a personal account is this. I've got a borrower, they've got two accounts. I've got a business account and I've got a personal account. I'm self-employed. How do I pay myself? Well, I take money from my business account and I transfer it into my personal. I'm paying myself, right? So that's the concept of a personal bank statement loan versus a business bank statement loan. Personal bank statement lending, we consider if the borrower can produce a 2-month business account, we consider all that money in that personal account the borrower's personal income. So I don't have to account for their percentage of ownership. I don't have to apply an expense factor. This is their personal money. So a little bit different calculation when it comes to that personal bank statement. So very different in how the income is calculated, and a loan officer may look at both, right? That's the whole point today is, are we working with loan originators who can get outside of that vanilla Fannie Freddie box that you run through an automated system and you follow findings, and can we understand all of the ins and outs of non-QM so that we can qualify more borrowers on their purchase and their refi transactions. So really kind of went over all this on this personal bank statement loan. So hopefully you understand the concept on that. Now, the one thing about personal bank statement lending is, if I don't have a separate business account, right? Let's say I'm one of those 33 million small entrepreneurs we have in our country, and I don't have a business account. I only have a personal account. I'm a small entrepreneur. I run everything through my personal account. That happens all the time. That's okay. I could still use that personal account if they don't have a separate business account to show me, but now I got to treat the personal account like it's a business account. I got to know the percentage of ownership. I got to apply an expense factor. Why? Because I don't have a business account. This is now my business account, and I've got to treat it that way. So something to recall on that. 1099 gross calculation. This one's pretty simple, right? We just get last year's 1099 and year-to-date bank statements, as I mentioned, and divide it over the applicable number of months. Longer I go in the year, right? Let's fast forward and say it's November. I would have, 10 months of bank statements plus my 1099, and I divide over 22 months. So longer I go in the year, the more bank statements I need. Maybe the 12-month bank statement loan would be better. I don't know, right? But once again, let's look at these borrowers from every potential angle to make sure that we're putting the most folks in homes that we possibly can and still doing it in a very responsible, disciplined manner. That 1-year P&L, as I mentioned, just to go over that, is the net income from the P&L times whatever percentage the borrower owns divided by 12. If I don't own all of the business, I don't own all the net income on that P&L. Remember, it has to be prepared by a EA, a CPA, or a CTEC. A little different than that expense letter, right? As to who can prepare that, and that's why you're working with originators who can direct your client to the right solution for them. This is actually asset utilization. This is that feature where I get to use the borrower's assets without them having to liquidate it, pledge it, do anything with it. It's their money. They do whatever they want with it after they close. We're not securing it. We're not touching it. They're not asked to liquidate it. They're not asked to take out a monthly withdrawal so they can qualify for a mortgage, right? This is their assets. They can keep them intact. We just do math. A borrower can use checking, savings, and money market 100% of the balance, 100% of a trust account when the borrower's sole beneficiary, 80% of stocks and bonds, and 70% of their retirement account. I don't have to be of retirement age. I don't have to prove that I can access that retirement account. A lot of these assets as income features make a borrower show you on that retirement account that they can either take a loan or they can make a hardship withdrawal. Well, some 401ks or retirement accounts you can't access unless you terminate your employment, right? So that would be out in most other cases. Here, we're not asking about that. We're just taking 70% of that balance and utilizing it as income regardless of their age or liquidity. So they give a 6-month asset statement. I can use this feature to either solve debt ratio problems or solve employment problems. Or maybe I'm retired. I'm on a fixed income and I got a debt ratio problem, but I've saved my whole life. I got all this money in stocks, bonds, or retirement accounts. I don't want to touch it, right? That's my safety net. I can use it as income without having to touch it. So a lot of situations come up where the borrower's assets can solve problems. So your loan officers who do thorough interviews for your clients are always going to ask, tell me about your checking, savings, money market, any trust that you're beneficiary of, stocks, bonds, or retirement assets. They may not ask for paperwork on it, but at least they're going to have a verbal idea of these borrowers' asset situations so they can provide the best possible solution, right? Think about investors. A lot of your professional investors have huge assets. So think about doing no employment, no income, no debt ratio and qualifying an investor just off of a 6-month asset statement. They get to keep the asset. They don't have to liquidate it. Second homes, primary can be used across the board for purchase and rate and term refis. This is to give you a breakdown. I don't want to bore you agents with all the detail on this. This is what your loan officer is going to do. They will plug in all of the figures on your borrower's assets. They got a great little calculator, and it will tell them what that usable income is if we're doing a debt ratio. Remember, 50% of this borrower's income can go out in debt. So I could use this supplementing other income. Maybe I'm doing a bank statement loan or 1099 or 1-year P&L. I've looked at all those avenues and I still can't get that borrower within that 50% structure. Maybe I could supplement that with their assets and make that loan work. Maybe I got an employment issue. Man, this borrower's 9 months self-employed. That's problematic in the mortgage world. So maybe they got assets and I can do no employment, no income, and qualify at a 50% debt structure. Or maybe I want to not do a debt ratio. I'm that guy with $5 million in a retirement account purchasing a $2 million home who really cares about their debt structure, right? Their employment or their income. They got plenty of money. So that could be used that way as well. Now, I mentioned that the bulk of these borrowers have 700 or up FICO, only 32% fall below 700. So there are those 32% of borrowers who may need a lower FICO loan, right? Maybe I've got a 620 FICO. That's the lowest these products would go. So that's the point of the non-prime product, is to serve those borrowers who may not be in that higher FICO range. It's a small percentage. I mean, this is a very small percentage of the market, but it's there. And once again, don't you want to partner with an originator who's going to look at every possible angle in a disciplined, responsible way to help that borrower qualify? So all the way down to 620, I could take a self-employed borrower whose net reported income on that tax return is problematic and use that bank statement feature or the 1099 plus bank statement. Now, 1-year P&L, that very light doc income always is going to require a 660 FICO. So as you can see, this is not the old subprime market where we're making irresponsible loans. We all know where that led us in 2008. So here, right, I got to have a higher FICO at 660 if I want to just show a P&L. That's a very light way of looking at a borrower's income. So we want that security that that borrower has the higher FICO, where that bank statement or 1099 or 1-year full doc could go all the way down to that 620. The other use of this product is for a borrower who may have had some recent credit events. We are seeing nothing alarming. I don't want to alarm anybody, but we are seeing nationally an uptick in some delinquencies. Credit card, mortgages, starting to be an uptick, right? That strain, that economic strain is starting to show in delinquency numbers. So, we have a ability to help a borrower who may have had some recent mortgage lates. We have more equity in properties than ever recorded before. So, we may be able to, certainly doesn't affect the purchase money, right? Unless you're using this for a lighter FICO to purchase a property. But if I've had some recent mortgage lates, right? Maybe I got 2 times 30 days or 3, that's, 3 by 30 is not going conforming. Sometimes even 1 30-day late, depending on down payment, et cetera, can be problematic from a conforming standpoint. So this product allows for some more recent mortgage lates to help these borrowers get back on track. The other use of this product would be for lighter seasoning on bankruptcy, short sale, deed in lieu foreclosure, just 24 months seasoning for second homes and investment, and just settled for a primary residence. So helping borrowers get back into home ownership. Now it's going to be lighter loan to values. These borrowers are going to need more money down. It's a higher risk loan. Once again, we learned a lot from '08, didn't we? So we need a little bit more money down if we're going to be dealing with a borrower who may have had some credit challenges. This product also serves an ITIN borrower, meaning I live here, I work here, but I don't possess any legal status here. So ITIN borrowers can be served under this non-prime product as well. Last product I'm going to go through with you today is the debt service coverage ratio loan. This is for your investment product. So this is specifically for a borrower who is going to be purchasing or refinancing a property with the intent of renting it out. This is a beautiful program and runs about 43% of this volume here. So it's a good opportunity. We talked a lot about the investor and the opening, and this is the most favored product. Why? Because I don't have to verify the investor's employment, income, or debt structure. I don't even have to ask where they're employed. This product's all about the cash flow of that property. So we would calculate the gross rental income on the property divided into the PITI. On a cash out refi, I got to cover my payment by 100% with the gross rental income. If I'm purchase money, I could be upside down. I only have to cover my payment by 3/4. So very light doc loan for investors qualifying off of the cash flow of the property. So how are we going to get that number? How do I figure out the income as an originator? If there's a lease agreement on the property, we would use lesser of the lease agreement or whatever the market rent comes in. You may not know, but on investment property, when the originator orders that appraisal, they get a rent comparison, right? It's a form, 1007 or 1025. It tells, based on comparable properties, what the average rents will bring on this property. And that's what we use. So whether it's a purchase or a refi. Maybe I'm purchasing a vacant property. There's no existing lease, and my intent is to turn that into my rental, or maybe I'm purchasing somebody's primary or somebody's second home, and my intent when I purchase that is it's going to be my investment property. That's fine, right? Not every purchase is going to be an investment property already. I'm turning it into mine. So all the loan officer has to do is go off of the rent schedule is what the appraiser says the average rent would bring on that particular property. It also will serve short-term rentals as well, so be mindful of that. Long or short-term rentals apply. This borrower needs a 660 FICO, so again, I'm not going to take a 620 borrower and not verify employment, income, or debt ratio, right? This is a 660 FICO. We're dealing with a good credit score and basing the loan on the cash flow of the property. They do need a 20% down payment. So the maximum loan to value is 80. They can go up to 2.5 million. This also helps with a foreign national borrower. A lot of foreign nationals purchase a lot of investment properties in our country, and you can serve that demographic of borrower as well. The other beautiful thing about a debt service coverage ratio loan is reserve. Our borrower in the conforming arena, every additional finance property they have, they've got to show the loan officer that they've got a certain number of months in reserve in the bank account to cover that payment. Fannie and Freddie in the conforming world also cap that borrower at 10 finance properties. Once I hit 10, I got a problem. I can't get any more. It's why so many investors wind up in hard money. But if loan originators sold this product, right, when you're dealing with originators who sell these products, they'll give the borrower this alternative. Here, I only need reserve on the subject. I could have 70 finance properties, as many as I want, many as I qualify for, and I only need to show reserve on the subject. Keeps paperwork down, keeps asset verification down. Your loan originators can also serve that borrower who likes the LLC. Often borrowers in the investment arena want to place the vesting of that deed in the LLC at close, and they're allowed to do that in this arena. Also can expand out to 5 to 9 units. Non-warrantable condo, no cap on investor concentration. You may or may not know, but Fannie and Freddie, they look at investor concentration based on the occupancy of that property and have certain rules around it. We don't. I don't care if it's a primary, second home, or investment property. Every one of those units in that complex could be investment. They could all be short-term rentals, right? So no cap, another benefit. You can also go out to that 5 to 9 unit property and you can do a first time investor. I don't have to be a seasoned investor up to 4 units to qualify. So you can help folks who may want to get into the property investment. I really believe personally that a lot of the reason investment property is increasing by 7.3% every year is people are using that as a retirement plan, right? It's a good income stream. Um, Refis, really not applicable a lot to you folks in the real estate arena, but you could do a refi and cash out a borrower even if they've owned the property less than 6 months. Very different than Fannie and Freddie. So an opportunity there may help your purchase money because maybe I want to cash out a bunch of my properties and buy another one. I'm going to pay cash for a new one. I don't know. So opportunity in the refi arena. We are running short on time. We do have second lien products, so a lot to cover in this amount of time. But just know if you have borrowers who are looking to cash out their equity, non-QM also supplies alternative ways for that self-employed borrower to qualify. What if I have a lot of equity, but my net reported income on my tax return is problematic to get a traditional second lien? You can use that bank statement loan or that 1 year P&L loan and help a borrower pull their equity out. Maybe they want to pull equity out to buy a second home. I don't know. So whether it's purchase money or a borrower already owns their home, you want to partner with someone who has a full suite of product and can help those borrowers with alternative income solutions, even in a second lien position. What am I doing on a non-warrantable condo? What if I bought a condo and it was warrantable at the time, and then something changed in that HOA? I go to pull equity out and I can't do it because that condo doesn't meet the agency guides, right? So, opportunity, I think, for marketing there. As we've talked about, non-QM lending is exception based, meaning if it doesn't fit the guidelines, there is an opportunity to do the loan anyways. That's never going to happen with Fannie Freddie or a prime jumbo. You're not going to call Fannie and Freddie or the lender and go, hey, yeah, but they've been on their job 26 years. They've been in this home 7 years. They've got a huge amount of money in reserve. I know it doesn't fit the box, but I've got all these compensating factors. Will you do the loan? No, I won't do the loan, right? Fannie, Freddie, prime jumbo, it is what it is. It fits or it doesn't. There's no telling a story. There's no looking at compensating factors, where here there is. About 20 to 30% of the loans closing here are done outside of what that guideline says. It's common sense, risk level, responsible, disciplined lending, but looking at some common sense areas. A good opportunity, I think, there. Please work with the Tide Water Home Funding, work with the loan officers there. They can look at that condo in advance. They can look at these borrowers in advance. They can dot the I's, they can dot the T's. They can make sure that you are looking at every possible avenue to close as many well-qualified borrowers as you can. They will look at that bank statement income in advance, just like they would a full doc borrower, right? There's no loan officer that's going to tell a borrower to go purchase a home without looking at their income, right? So they're going to be asking for those bank statements up front before that borrower has a purchase agreement and analyzing to make sure that they can qualify. Maybe they're going to be using assets, right? There's a tool that the loan officers have. They can plug the assets in. It does all the math. There's scenario calculators tool to help the loan officers navigate through and see what eligible products that there are. So a lot of support for originators in reference to making sure that these loans close as expected. So thank you all.